Well, capital inflows, foreign direct investment, portfolio investment in Africa are all on the rise. But all of this as the world recovers from a recession. But just how ready is Africa for all of this investment? To find out, I'm joined by Fungai Tarirah, Fund Manager at RMB Asset Management. Fungai, thanks for joining us. We've got the World Economic Forum starting tomorrow in Tanzania. The theme there is rethinking Africa's growth strategy. But as we see the global recovery taking place, we've got increased interest in Africa, but are we actually going to reach those levels that we reached pre-crisis in 2007?
Well, I think there's a number of indicators out there that are sort of showing that interest has come back in a very large way. We're still trying to retrace some of the ground that has been lost since the crisis, but I think there's pockets of encouragement out there. I mean, if you look at value traded across some of the exchanges, for example, you'll see those numbers are up quite significantly over a year ago. You know, the first 4 months of 2010 have been quite strong compared to the first 4 months of 2009, for example. In places like Kenya, that number is up 3.3 times. In places like Ghana, it's up 68%, Nigeria up 79%. So you're seeing those inflows starting to come through. Coupled with that is the fact that quite a lot of foreign direct investment, which had actually been pulled back during the crisis, has also started to come back into various projects that had been earmarked across the countries.
Just, I mean, we'll get into equities just now, but just in terms of a macro view, there seems to be a trend across the continent for governments essentially to tax. We've just heard about the levy being imposed in Zimbabwe on that indigenization law. We've got Zambia taxing mining houses, Tanzania taxing. We've also got a story out of Kenya today to further regulate the telecoms market. Are we going to lose that investment if governments carry on these regulatory mode?
Well, the world over, from Australia to the United States to Zimbabwe to any of the countries that you've mentioned, new taxes, new excises are coming through, and I think the world over the response from investors is pretty much the same. Investors shy away from extra taxes or high tax regimes, so that is something governments have to actually think about when they put these into place. But one must also remember that quite a lot of governments have put through some counter-cyclical stimulus during the crisis, and some of that money has to be clawed back from somewhere. So it's about finding that delicate balance to make sure that governments can actually earn something from the natural resources of the country while business is still incentivized to actually exploit those resources and everybody can benefit.
And obviously one of the ways that governments can get some of that cash back is through bonds, and we're seeing decreased yields or lower yields, and we are expecting more investment in debt markets. We've got Angola, who is going to be issuing their first credit rating, which is expected to bring in around $4 billion worth of bonds to foreign investors. Angola is obviously a hot spot right now.
Yes, I think a number of things have conspired to make it a very good environment for declining yields. You see inflation is coming down, and you also see better management across the various economies across the continent. And also the fact that risk or people's risk perception of a lot of these countries has actually come down somewhat. So you find a lot of countries are actually coming through and talking about issuing sovereign bonds. Nigeria is also looking to put together a $500 million bond issue, and Kenya has also indicated that they might raise some $400 million over the next 2 years. So I think it's a very good time for them to actually come to the market. Of course, credit ratings are essential, and we'll see in the case of Angola how that actually turns out. But obviously, if they can get those sort of credit ratings coming in, that just increases the chances of getting more of that capital flow to come through.
Of course, Tanzania has come out and said that they're not interested in getting a debt rating because they say it's responsible for the global financial crisis. But just on another note, in terms of a fund manager, you obviously manage 2 funds in Africa, and we just got some comments out from Stanlib yesterday saying that the markets in Africa are too small and they're scraping to try and find places to invest their money. Is that a problem that you're encountering as well?
Liquidity has always been of huge concern to anybody that invests in stock markets across the African continent. A lot of people, I think in the early days, used to focus on sub-Saharan Africa, ex-South Africa, and try to play in that sort of area because I think the GDP dynamics and also the country dynamics fit better in terms of just classification, but you'll find that obviously liquidity is running out in that area. I mean, just to give it context, if you look at sub-Saharan Africa, ex-South Africa, that market cap is about $112 billion. If you look at North Africa alone, just the three countries, Egypt, Tunisia, and Morocco, where foreign investors can actually participate, that adds another 158 billion. So I think people have to sort of open up their minds and the areas in which they actually want to participate in. And I think we'll also see people moving into other asset classes, not only sticking to listed equity. But obviously, as more and more financial services providers come to the continent, we should see more issuance, which is a good thing.